You know how this story begins. On February 28, the United States and Israel attacked Iran. This triggered an effective closure of the Strait of Hormuz, the narrow shipping lane for global oil. Roughly 20 million barrels of oil pass through this artery every single day. At the peak of the crisis, flows collapsed to around 9.6 million barrels per day. This was less than half of normal volumes, the largest supply disruption in history. To put that into context, you have to go back to the 1973 Arab oil embargo. In 1973, the embargo pulled about 4.5 million barrels a day off the market. This sent prices up nearly 300%, nearly quadrupling crude from $3 to $12. But the 2026 Hormuz shock pulled out roughly twice that volume. A fifth of supply in 2026 caused a temporary jump of about 65%, from $72 to $115, and then it handed the gains straight back. A bigger shock, but a smaller, shorter spike. So, why exactly was it averted? Well, for an answer, we first need to look to China. The world's biggest oil buyer simply walked away from the market. In May 2026, China's crude imports fell to 7.82 million barrels a day. That's an 8-year low, the weakest reading since 2017. Before the conflict, China was pulling in close to 11.7 million barrels a day. The data shows a significant increase in market share. Our strategy is clearly working. China spent years preparing for this oil scramble, diversifying energy sources. China was sitting on an estimated 1.2 to 1.4 billion barrels of crude. At the peak of the crisis, it was drawing on those stockpiles at 1 million barrels a day. China ran down its own stockpile rather than chase a panicking market. Research by J.P. Morgan estimates that China's import pullback accounted for 74% of the total decline. The biggest buyer on Earth wound down a lot of its buying. That single act of restraint did more to cap the oil price than anything on the supply side. But the bigger question is whether Chinese demand ever fully comes back on stream. In May 2026, 62.9% of new cars sold in China were electric vehicles. For the first time, internal combustion cars accounted for less than 40% of the market. The IEA now expects Chinese oil consumption to fall by 360,000 barrels a day in 2026. This is a permanent shift rather than a temporary market fluctuation. So, while some of China's missing demand will return, a chunk of it is gone for good.
If you want to keep track of stories like this, check out the Finance Bureau newsletter.
It's free, and in it we break down the latest in markets, monetary policy, macro, and more.
Welcome, I'm glad you're here. Let's discuss this together, and I believe we have a solution. I am here to help you.
Okay, back to it, because while China's absence held the line on the demand side,
on the supply side, governments reached for something they almost never touch: the emergency reserves.
In March 2026, 32 nations launched a coordinated release of around 400 million barrels of oil.
The United States did the heavy lifting, releasing 172 million barrels from its strategic petroleum reserve. Before the conflict, the SPR held over 415 million barrels, and today it sits at around 326 million. This is the lowest level since 1983, and this isn't just an American problem. Government-controlled stocks across the developed world fell by 163 million barrels. So the price shock was contained by spending the rainy day fund, which is what it's for. But while the SPR was being drained, government auditors were writing a report about the state of it.
The Government Accountability Office warned in June 2026 that the SPR faces a real risk of operational failure. Officials described the infrastructure as being held together with Band-Aids.
To bring the reserve to full operational standard would cost around $650 million.
Only about $389 million has been approved, leaving a shortfall north of $260 million.
One major site in Louisiana has been cut from the repair program entirely. So the buffer got drained to its lowest point in 4 decades, and the machinery is crumbling.
Now, another thing to bear in mind is that the Strait of Hormuz was never fully closed.
So it was restricted. Nevertheless, with traffic reduced, countries began exploring ways to bypass it entirely.
Saudi Arabia's east-west pipeline was ramped up to record throughput, sending crude over land. The UAE, meanwhile, ran its Habshan-Fujairah pipeline at maximum, adding another 1.5 to 1.8 million barrels. And then there's the so-called dark fleet, the tankers that switch off their tracking transponders.
Their activity went from a trickle to a stream, moving 1.9 million barrels a day of crude. The United States stepped in as the supplier of last resort, with crude exports hitting record levels.
However, none of this came close to replacing 20 million barrels a day. Analysts called the bypass capacity woefully insufficient.
But it was enough to keep a trickle flowing, while everything else absorbed the shock.
Okay, now so far, we've talked about how the big players kept the show on the road.
But all that machinery, the reserves, the bypass pipelines, the record exports, belongs to the wealthy. For the smaller, poorer nations at the other end of the supply chain, there was no rainy day fund. Take Pakistan, for instance. It imports the overwhelming majority of its oil.
It pays for that oil in dollars it's perpetually short of.
So, when crude prices spiked, the import bill ballooned, draining foreign reserves. The key to success is careful planning and a commitment to detail. That's why our strategy focuses on precision at every stage. It imposed rationing. Fuel was funneled to essential services. The United States stepped in as the supplier of last resort, with crude exports hitting record levels. And the government leaned hard on cheaper, discounted Russian crude just to keep the lights on.
Elsewhere, Sri Lanka, still nursing the scars of its 2022 default, faced a grimmer version.
Fresh from one fuel crisis, it was staring straight down the barrel of another. Out came the QR code rationing system again, capping how much fuel each vehicle could buy. Non-essential imports were restricted, and officials scrambled for emergency credit lines. In both cases, the pattern was identical: no buffer, a currency under siege, and a population simply told to go without.
And these are just two examples.
Many other countries face similar hardship. The rich world spent its reserves,
while poorer countries made do as best they could with the struggles of their people.
putting higher pump costs in places like the US and Europe into pretty stark perspective.
Right, now there's one more reason why, despite the massive disruption caused by the conflict, we still didn't see oil prices go parabolic, and it's a pretty straightforward one. And
high prices did what high prices always do. They killed demand. The IEA cut its 2026 demand outlook by roughly 1.8 million barrels a day in total,
swinging from an initial growth forecast to a projected contraction of 1.1 million barrels a day.
Second quarter demand came in roughly 5 million barrels a day below the year before. So, the worst quarterly performance since the COVID lockdowns. The World Bank, meanwhile, slashed its global growth forecast to 2.5%.
Blaming the conflict directly. As such, by June, the IEA wasn't warning about a shortage anymore, and was instead flagging a potential supply surge of around 8 million barrels a day for 2027. Welcome, have a seat. I've reviewed the proposal, and I think we can make this work. What's your take on the timeline? Excellent, let's get started right away. We went from the biggest shock in history to talk of a glut in a matter of weeks. So that is how $150 a barrel oil never happened. China walked away, the reserves were flung into the breach.
The bypass routes took some edge off the shock, while demand crumbled as prices went higher.
Nevertheless, there was still a bill, and it had to be paid.
US gasoline went from around 3.40 a gallon before the conflict to a peak of 4.56 in May.
A jump of roughly 34%. And by a conservative estimate, American households paid roughly $33 billion in extra fuel costs because of this conflict. And that figure, by the way, is the narrow one.
Just the cost at the pump. Broader estimates that fold in diesel, jet fuel, and the knock-on effects
run far higher. The system held, but ordinary people still paid the price.
And will continue paying it for some time to come. And remember, that $33 billion figure
is an American one, cushioned by the largest strategic reserve on Earth and record domestic production. Spare a thought for the Pakistans and Sri Lankas of the world who had neither. For them, there was no buffer to spend, only rationing, borrowing, and going without. And when the next shock comes, it's these nations, not the well-stocked West, that will feel it first and feel it hardest. Because while there are now hopes for peace,
and oil is moving through the strait once more, there are a few things to remember.
For one, those reserves have been significantly run down and will need to be refilled.
Meaning demand is likely to stay elevated, and that will be reflected in the price of oil.
For some time to come, the ramping up of bypass capacity by the likes of Saudi Arabia and the UAE
means that Hormuz may become less vital for oil transit in the future.
But there's a lot of work to do before that workaround can be built out. To make a meaningful dent in the volumes that have to flow through the strait. And of course, while the fighting has stopped for the time being, and both sides are at the table. There's no guarantee that the conflict won't start up again and Iran chokes off the strait once more. Perhaps before those reserves can be adequately topped up. Even China, which is leading the way in electrifying its economy to make it less dependent on fossil fuels,
will need to restock its reserves and keep consuming oil for years to come, albeit perhaps less than before. The good news is the oil shock was contained.
Before things got really hairy. And for the wealthy world, it was contained at a manageable price. But as Pakistan and Sri Lanka and many other countries remind us, that safety net doesn't stretch to everyone. For the nations without a reserve to raid, the next flare-up could be existential.
And with the world in 2026 getting ever more volatile, that next flare-up may be just around the corner.
Let's hope we're stocked up and ready for when that day comes.
Okay, that's about it from me for today, though, but let me know your thoughts on this.